While Schedule 1 to the CGST Act that tends to bring within the tax net supplies without consideration includes supplies between distinct and related persons, it is equally justifiable that cases of revenue sharing do not involve any supply. So, the question of applicability of Schedule 1 does not arise. Good morning, good afternoon and good evening, ladies and gentlemen. In this video, we will see how the implication of GST on revenue sharing models is posing a lot of conflicting opinions. Essentially, when two persons enter into a JV agreement contributing towards their funds and performing their respective roles, then such activities of the members performed in anticipation of profits should not be taxable because, number one, the members have performed such activities for themselves, because by doing such activities the members have contributed towards their capital in a way. Number two, the essential element of an immediate and direct linkage between such activities and consideration is also absent, without which a transaction cannot be subject to tax. Basically, the profits earned have no linkage with the activities performed, because there could have been losses also. In other words, the element of presupposition of consideration was absent when the activities had been performed originally. In fact, even the profits earned do not constitute as consideration per se, because the profits earned are in the nature of financial transactions, constituting return on capital invested. Merely by treating the constituent members as distinct entities from the JV does not mean that the activities performed by the members should be taxed, because the JV is merely appropriating the consideration among its constituent members. Hence, in light of provisions of Section 71C read with Schedule 1 to the CGST Act, each revenue sharing transaction calls for close examination, and accordingly applicability of GST would be determined on case-to-case basis. Let's understand this by way of a few case laws. In the case of Media One Global Entertainment Limited, the Honorable High Court of Madras upheld the sanctity of Circular Number 148/17/2011 dated 13/12/11 of the erstwhile service tax regime, which clarified that where one independent entity enters into an agreement with another independent entity with a clear understanding to share profits and revenues and not to provide services on B2B basis, a new entity emerges distinct from its constituent members. As the new entity acquires the character of a person, transactions between it and its independent constituent members would be subjected to tax. On the other hand, in another interesting case of India Cements Limited, C-Stat Chennai held that both the independent entities are just pooling their resources, doing their part of the activities and taking risks of uncertain income, and that there is no service that is being provided by one party to another. The tribunal further held that since the consideration was received centrally in the hands of one entity, it is being shared with other members, it is being shared with other participating members, and this routing or appropriation of payments do not constitute sufficient evidence of provision of a service. So, ladies and gentlemen, please let me know about your views on this video in the comment section below, and please do hit like, share and subscribe. Meet you in another video with another enlightening topic. Bye.